Hi guys, good afternoon and welcome to the CNBC TV18 Mumbai News Center. I'm Pavitra Parekh. With me is Sonal Bhutra. You guys are tuned in Mutual Fund Corner, and today we're going to do a complete deep dive and get you an explainer on how best to approach sector and thematic funds at a time like this. Now, this category has actually seen flows all over the place. The chart will be up on your screen, so you can see that it's been quite shaky, how the inflows and outflows have looked. So we're going to talk about that. And also, Sonal, at a time when we are seeing so much divide in the market, we're talking about IT being down, banks doing really well. It's a good time perhaps to talk about this space.
Oh, yes, it is. And that's the reason we have shaped up the show for you today. To talk about this and a lot more, let's welcome Ashish Shankar, the MD and CEO of Motilal Oswal Private Wealth. Ashish, good afternoon. Thank you so much for joining us. Well, as Pavitra was mentioning, it has been very volatile when it comes to flows in the sector or thematic funds. So what do you make of the flows we have seen so far in sector and thematic funds this year? The data all over the place. Is this usually a category where you expect to see such a big move?
Hi, Pavitra. Hi, Sonal. Pleasure to be on your show. So like you said, the flows have been about, we saw the numbers, it's been about 60,000 crores. And sector funds are basically 11% of the total equity MF AUM. So as expected, it's not a very large number. The sector funds, look, there is a lot of rotation which happens on a year-to-year basis, right? There are some years where certain sectors do well, and there are other sectors which then take over. So if I look at the data over the last 20-odd years, there is no sector which has consecutively been the best performer in 2 calendar years. And there is rarely a sector which in a 5-year period, it has been the top performer in 3 out of 5 years. So clearly sector funds are not for beginners or for investors who are busy and they want to build a nest egg over a period of time through SIPs. Sector funds are basically for sophisticated investors who understand sectors, who have time to do their research, or for investors or clients who work with advisors who may be better equipped to analyze the data and then suggest sector funds to their clients. So that's why if you see the data is all over the place. But typically what happens is towards let's say a peak of a market, when there is frenzy for a particular sector, you see a lot of money moving into that particular sector.
Okay, Ashish, I'm going to come back to that and ask you perhaps which are the best sectors at a time like today, because that's what our viewers would want to know. But before that, at a time when we're talking about the market being so range bound, perhaps at the index level being so range bound, if you are to look for more pockets where you can generate better kind of returns, do you think at a time like this, sector funds are a good choice? I know, of course, like you said, not perhaps for a new investor who's not too educated on the market, but at a time like this, do you think that these funds should be considered more strongly?
So, see, for sophisticated investors, sector funds can be quite useful. So like you rightly said, if you look at this year, the index has been range bound, but there are certain sectors which have done extremely well. PSU as a pack for one. Then in the last 6 months, if you see the banking and financial services sector funds have done extremely well. So for investors who are discerning, or for that matter, investors who are probably involved in a certain sector. So let's say, for example, if an investor is a banking and financial services professional, well, clearly he has an edge when it comes to analyzing that sector. And if that sector is looking good and probably underperformed in the past and ripe for a let's say move up, then such an investor can take advantage by adding a certain portion of his portfolio in a banking sector fund. Similarly, if somebody, for example, the pharma sector has underperformed last 5-6 years, and a lot of companies have seen huge corrections. But let's say if an investor is working in that sector and he or she feels that this is a sector that is probably going to do well over the next 2 to 3 years, then such a person can add a little bit of pharma to their portfolios through a sector. The best part is, if you're bullish on a sector, you don't need to then spend time picking stocks. You can give it to the sector fund manager, who then decides which are the best companies in that particular sector. Or for that matter, if you're working with an advisor and that advisor feels that a particular sector is underrepresented in the index or in large diversified portfolios, and he or she believes that the next 2 to 3 years are looking good for those sectors, then the advisor can probably tell his investor or client to add a little bit of that sector in the portfolio. But clearly, if I just give an analogy of a meal, right, it cannot be the main thali. It has to be a dessert, or it has to be an add-on in the portfolio, right? And there are other nuances which we'll probably talk about,
Yes.
as we go along.
Of course, we will talk about that, but you've made us focus on desserts, Ashish, right now. So that's also what we are thinking about right now. But jokes apart, you briefly spoke about how to be selective in these funds. Actually, you also spoke about banking as one of the themes. What is the case for sector or thematic funds? Are there any themes which you are looking at or which you think could be attractive? And what should the investor look at here while choosing these funds?
Yes, see, if you look at the trend, right? I see a clear reversal in the themes. If I look at the last 1 year, 2 year data, a lot of sectors have been neglected in the last decade, and namely cap goods, engineering, infra. Similarly, if you rewind back 6 months, banking as a sector was neglected and hence underperforming, because you saw FIs selling and FIs sold quite a bit from that sector. We do believe that the next 4 to 5 years, sectors which have been underinvested in, namely infra or even real estate for that matter, some of these sectors should do well into the next 3 to 4 years. Now, the fund managers who've done well in the last 5-6 years probably have sectors which have done well in the last 5-6 years in their portfolios. So your portfolio may be underrepresented in some of these sectors that I just spoke about. So having a broad-based sector fund like an infra fund or even a banking fund. Why I'm a little apprehensive about recommending a banking fund is because most diversified portfolios anyway have 25 to 30% of their exposure in banking and the finance sector. But having said that, we are quite bullish on the banking sector over the next 3 to 5 years as credit growth picks up, and a lot of these banks, even the PSU ones, the balance sheets have got cleaned up. They are well capitalized, and they are well poised to capture the next phase of growth in the economy.
Yeah, and they're underperformed for such a long time. So even after this rally, I guess the general view is that there is lots more left in terms of what these banking names can do. Ashish, the next question is that, of course, we've spoken about the case for investing into these funds. What are the key risks that you should keep in mind as well? Because that is something that maybe a newer investor, someone who's not so well versed with the market, should be aware of before they dabble into this space.
Yes. So 3 key risks. First is these funds tend to be far more volatile than the diversified counterparts. If you look at the data, right, no sector has been the top performer consecutively for 2 calendar years. So there is a lot of rotation which happens in the market year to year. A sector which is top performing this year can be the worst performing sector the next year, and so on and so forth, right? So these sector funds tend to be extremely volatile. So one needs to be very clear in terms of what is your time horizon and the fact that you are able to stomach the volatility. Second risk is that these funds need to be exited, right? Sometimes sectors go out of favor for a very long time. And case in point is, if you look at the 2003 to 8 cycle, right? The real estate infra sector funds did extraordinarily well. But after the crash in 2008, they again came back in 2010. But after that, that entire decade, 2010 to 20, was a lost decade for these funds, right? So sometimes sectors or themes can go out of favor for a very, very long time. So these sector funds need to be exited. The third, so you need to time the entry and time the exit. And that's why I keep saying that these are funds for more discerning investors or investors who have more knowledge about that particular sector, or somebody who works with an advisor. The third risk can be that, even if the sector does well, if you pick the wrong fund and the fund manager goes wrong in picking companies, then you can see some underperformance in your portfolio. So that's the other risk. So one should be mindful of these risks, but definitely, there is value to be created if one, is doing it right.
That's right. But it's always, as you said, important to know the risk as well before investing. That's always the disclaimer from experts as well. So, Ashish, in that case, is sector investing largely about taking contra bets? If, say, you do want to invest in a sector, do you just go for the most downtrodden one at a point in time and avoid the ones where we've already seen a good move? Or is it more than that?
I think sector funds is more than taking a contra bet. Like I said, a sector can be underloved or underinvested for a very long period of time. For example, between 2010 to 20, PSUs, infra, real estate, every year on year would have been contra bets, right? But it's not necessarily that it would have worked, because for a long time, these sectors didn't work. So I think it is about marrying your conviction on a particular theme for the next 3 to 5 years, and looking at sectors which are probably underrepresented through the diversified funds that you hold. So it takes a little more sophisticated research and analysis than just saying that okay, this sector has been unloved for the last 2 3 years and hence it's a contra bet and let me go and invest. It takes a little more analysis and deep dive than just looking. A contra sector may be a good place to start your research on, right? Something which has been underperforming for the last 5 years or a slightly longer period may be a good area to start your research, but it may not necessarily be enough to create conviction and go out there and invest in that particular sector.
It would be too easy, right? If it was that easy to invest in a sector fund, then we would just pick the worst performing at that time and hope to make lots of money. But Ashish, in this context, when we are talking about how sectors, perhaps the ones which have been underperforming, are a good place to start your research, what do you think of the IT sector? Of course, we've seen sharp cuts here after that solid rally, also after the whole pandemic period. Do you think that this is perhaps a good theme or like good sector to be getting into and looking at?
It's not very clear when I look at the data for the IT sector, to be honest. I mean, unlike, let's say, a PSU or a banking sector fund, IT sector has not necessarily been an unloved sector. If you look at the last decade, the entire rally has come in the tech space. Of course, you can argue that the companies in NASDAQ are very different to the services company in India. But otherwise, the IT sector has not necessarily been unloved. I mean, valuations have come off over the last 7-8 months, because what happened was last year IT sector did so well that the valuation multiples had expanded for a lot of companies. So you've seen a little moderation in valuations, but I mean, by any yardstick, they're not cheap, right? So it's not very clear, I mean, to take a sector call, to be honest.
Okay, so we take that point on this note, and Ashish, stay on. We'll just get into a quick commercial break and we'll continue this discussion on sector funds on the other side. Stay tuned. Welcome back. You're still tuned into Mutual Fund Corner, and we still have with us Ashish Shankar to talk to us all about sector funds. Well, Ashish, it has been an interesting conversation so far. While we've asked you about risk and when to enter, I just wanted to understand, how can an investor know or decide when to get out of sector funds? It's essentially trying to guess when the up move is done and we may see a rotation in the market. How can an investor decide that?
Yeah, so this is a bit of an art. And a tough one, if you ask me honestly, because sometimes themes can last longer than you can expect. So my sense is that whenever you've seen the sector outperform the broader index by a huge margin, and let's say it's 3 years into that outperformance, then definitely you should start relooking at that particular theme. But it's a bit of an art. Sometimes, themes last 3 years, sometimes themes last 5 years. So I think it's very important to get the entry right. The exit, even if you exit a little early, it's fine. I mean, so I would recommend for sector funds that, once, if you've got the theme right, if you've entered right, and let's say you're 3 years into the theme or 4 years into the theme and you have a massive outperformance, then a gradual exit is what I recommend. But it's an art, to be very, very honest. So that's why, as I said, somebody who understands the sector, understands the theme well, is more likely to get it right.
Yeah, I guess, the advice that you hear time and time again is don't try to time the market. But in this case, I guess that is what you're sort of making the bet on. Ashish, you were mentioning this earlier as well, that when a sector goes out of favor, it could stay out of favor for a while, right? There's no sort of limit on it. It could be a 3-5 year kind of situation as well. What is the kind of investment horizon that you think you should have before you consider any sector fund? Is there a minimum time period that you think you should have?
Yeah, as it goes with equities, I think you should minimum have a 3-year time horizon. But with sector funds, you also have to be nimble-footed. I mean, if let's say you're a year into the investment and there is a massive outperformance, then probably it makes sense to take some money off the table, right? So it's a combination of, I mean, you should always come in with a 3-year view because you could be early into a theme as well. And after you invest, maybe the sector actually underperforms and then starts picking up. So you have to come in with a mental mindset of 3 years. But as I said, you need to be alert and you need to be agile. So let's say you get the timing bang on and within a year, you see great outperformance, then you may want to, start taking some money off the table. Like we saw tech last year, right? Tech did extremely well up to September, October 2021, and multiples expanded. So you would have done well if you had taken some money off that sector.
Okay, interesting. So you partly answered our question as well when it comes to who's best suited to invest in a sector or thematic funds. What is your take? Of course, when you're talking about rotation, cyclicality, who can actually or who should actually go ahead and invest in such funds?
Yes. So as I said, I think somebody who's working in that particular sector and is probably more informed on what's happening in terms of trends. I mean, there are a lot of people who are employed in the pharma sector who understand the pharma sector deeply, or people in the banking and financial services or IT services sector. I think if you have knowledge about that sector and can interpret trends, then you definitely have an edge over most other investors, right? Secondly, if you have a good advisor and the advisor understands some of these trends and sectors, then you could work with them. Here, there is one thing which I'd like to add, which may be interesting for your audience. See, there are certain sectors which are extremely volatile, and there are certain sectors which are much more stable, right? And I'll give you examples. So let's say the commodity sector, or let's say infra sector or real estate sector. Now, these are very volatile sectors where the cash flows, numbers of these companies also vary in a very volatile fashion. But then there are consistent sectors like consumer, even IT services has been reasonably resilient and consistent. Or for that matter, pharma has deeper cycles, but the companies are profitable for a long period of time. So my point is that if you want to add sector funds, right, and if you want to do SIP, let's say you want to have it as a regular feature in your portfolio, then sector funds like consumer or an IT services, or to that extent, maybe even pharma are better suited, right? Because these are very long-term themes. Like consumer is a theme, let's say, for example, for the decade, as per capita in India keeps going up. But for that matter, a metals or a commodity sector fund or an infrastructure fund, these are very cyclical sectors, right? Here, doing an SIP and keeping it as a core part of the portfolio may not work. So this is another aspect of how to think about sector funds. There are consistent sectors where you can actually build a portfolio. As a satellite portfolio, like I said, is the desert. But certain sector funds, you need to be more nimble-footed, where you definitely need to exit.
Yeah, oh, absolutely. That point is well taken. Ashish, my next question to you is that, sector funds are offered across fund houses, right? There'll be a banking fund from literally every fund house. Do you think that, you would give more importance to sort of picking a specific fund house here? Does the fund manager become absolutely important? Because that, again, takes a lot of research and, the investor really knowing what he's talking about here.
Yeah, so then it comes down to analyzing these individual funds where you can take the help of a mutual fund advisor, but you can also look at the data, right? Last 5 years, last 10 years, and see which are the houses that have done well in certain sector funds. I mean, it's not necessary that the same house does well in all sector funds. So I think it's a matter of looking at the individual funds and also looking at size. I mean, it's a very easy way of doing it, because if a particular fund house has a size in a particular sector, which means that a lot of people have invested in that fund and there is some collective intelligence around it. But you could look at the track record of that particular fund house, because in a sector, see, once you've identified the sector, it's all about stock picking, right? If a fund manager has done well, clearly it shows that they have superior stock picking capabilities in that particular sector.
Again, somewhere where you will have to do a lot of homework. So please, be warned before you get into this space. Ashish, just one final question before we let you go. A lot of people confuse sector funds with thematic funds. We know these are very different, but how do you think the approach should change? And also, do you think thematic funds are perhaps a little bit less risky and better suited to someone who's not too sure which way the market is headed, or is not too well versed with the market, because at least within a thematic fund you will still have some kind of exposure to different sectors, right?
Yes, so you're right. I mean, thematic funds are less risky because they are much broader in terms of mandates. So, for example, let's say you take a consumer fund. Now, consumer fund can have consumer discretionary, they can have consumer staples, and possibly even auto. So they have a much larger mandate. So even within that theme, if a particular sector is out of favor, the fund manager can be agile and let's say change. Let's say you have an MNC fund, right? MNC fund is a thematic fund. Mandate is to buy foreign companies, right? But you now if you say that you have a fund which is going to invest only in real estate companies, right? A real estate fund or a housing fund, then you're getting more narrower. And there, if a particular sector goes out of favor for a very long time, like a pharma fund, if you have a pharma and healthcare fund, then it's a much larger mandate, right? You have diagnostics, etc. But if you just have a pharma fund, then it's a much narrower mandate. So narrower the mandate of the fund, obviously the risk increases. And the risk essentially is that if that particular sector is going out of favor for a prolonged period of time, there's little that the fund manager can do. But if it's a thematic fund, and even if the sector, a few particular sectors go out of favor, the fund manager still has maneuverability. So the thematic funds are much more suited for SIP or, staying in the portfolio for much longer. Whereas sector funds, you have to be more nimble and agile, and what we discussed about entering at the right time or exiting when they go out of favor, all those things apply.
Okay, so that was a masterclass into sector funds. Ashish, thank you so much for joining us and explain to us the nitty-gritties and everything that we should know about sector funds. Thanks a lot for joining us. And with that, it's a wrap on this edition of Mutual Fund Corner today. Stay tuned for Closing Bell to take you through the last hour of trade.